Okay, so chapter 5 involves 3 parts. All right, actually technically 4, but 4 is the part you're going to do at home, and the reason that you're going to do it at home or not in here is because it actually involves some things that did not make it into this textbook for whatever reason. When they did the new edition, they left parts of the annual report out, specifically the auditor's report, which we find very important, and we can't believe that Fred, who is the author, didn't include it again. So we have supplementary slides, which I'll give you, and then I'll have you answer a few questions regarding the annual report that I'll give you guys copies of. What the 3 that are included here, and the 4th that I talk about is kind of in regarding this, is fraud and internal controls, which is very theoretical. All right, so that just means there's no problems necessary from a calculation standpoint. So the beginning of this chapter is more just examples and talking about things, and then the second part is cash, which cash is very much regarding internal controls, but specifically what we'll talk about on Tuesday is bank reconciliation. Okay, that's one of the internal controls, but it's one thing that every company does. Sometimes it's a hard concept for you guys to get because you guys don't do bank reconciliations anymore. Right? You guys check your bank by looking at your phone. Right? That's just the way we do it. But in businesses, you can't do that. In businesses, you actually have to do a bank reconciliation. The bigger the business, the more bank reconciliations they're going to do. If you're a small business, you might still check your phone. All right? A sole proprietorship can have an idea of what's going on. But you really need to do a bank reconciliation when you're running a business. So we'll start with fraud and start with the definition of fraud. Who wants to give me a definition of fraud?
Anything wrong?
Anything wrong. Okay, so that means if you write your name wrong, that's fraud?
Which affects someone.
That affects somebody.
Yeah.
So if you do something wrong to somebody else, it's fraud?
If it affects the other person then, financially or...
So I'm making things up to prove that that's not exactly right. So if you were to tell them you're going to meet them at 5 o'clock and not show up, is that fraud?
No.
Okay. So take what you're thinking, maybe, Lucas, and streamline it a little bit.
I would say not plagiarizing legal documents, but not doing legal documents right. I had it and then I lost it.
Who wants to help them? Yeah.
It means deceive others for your own benefit.
Okay. The intent to deceive others for your own benefit. All right. So, okay. Now, is fraud illegal? Yes. Okay. So, when you're talking about, we're going to talk about ethics too. So, what's ethics?
Moral.
Ethics are more morals. So, are ethics illegal? Not necessarily. But is something illegal unethical?
Yep.
Yes. Okay. And you want to make sure you think about that. So your ethics is kind of like your moral code, right? What you live by. And is Colanda's ethics the same as Michela's? No, not necessarily. They actually could be, right? But they don't necessarily have to be. So if something is unethical to Michela, am I saying that right too, by the way? Okay. No, your name. Am I saying that right? Okay. I just want to make sure. If it's unethical to Michela, it's not necessarily legal. It's just something she doesn't think is right, right? And for example, in the political world, right, going on and everything right now, there's a lot of unethical things that may or may not be illegal. But if it is illegal, it is unethical. Like those two go hand in hand. And you want to make sure that you remember that. All right, so fraud typically involves finances, typically. All right? So when you commit a fraudulent activity, you're usually involving some type of money with the intent to deceive. Because you're not committing fraud and telling of someone you're doing it, unless they're doing the fraud with you. All right? So typically fraud, generally intent is an attempt to deceive others for personal gain. All right? If you're just trying to do something to mess with someone, like a hacker, there's some hackers that just like to hack for fun, right? That's not fraud. They're not stealing money. They're just going out there to mess with people, all right? And that could be illegal, or it could just be what most of us would deem to see unethical, all right? So there's different types of fraud. There's corruption, all right? There's asset misappropriation, and then there's financial statement fraud. All right, corruption comes from within a company typically. All right, asset misappropriation is assets that you are not allocating appropriately. There's a lot of different ways that you can do that. And then financial statement fraud is purposely knowing that you are presenting your financial statements that are inaccurate. Right? So, who knows what Enron is or was? You know what it is, Eddie, or are you stretching? Okay. You know what
They're
it
like
is?
an accounting firm, right?
They were not an accounting firm, but the scandal involved an accounting firm.
Like an energy company?
They were an energy company, all right? The largest energy company in Texas and one of the largest energy companies around.
I watched a document on this.
You what?
I think I watched a document.
You
on
probably
this.
did, because it was huge. It was, basically, it changed the way accounting is done, Enron did. And it was back around 2000, 2002, and Enron employed around 11,000 people, right? And it was an energy company in Texas. And Arthur Andersen, which is the public accounting firm you're talking about, there used to be 8 public accounting firms. They called them the Big 8. That was a long time ago. The Big 8 consolidated to the Big 6. All right, and then the Big 6 went to the Big 5. And the Big 5 were Arthur Andersen, Deloitte & Touche, Ernst & Young, KPMG, and PricewaterhouseCoopers. All right, and when you hear all those different names, that's how they always consolidated. They just became bigger names. So those were the Big 5 accounting firms. Arthur Andersen was the accounting firm for Enron. And typically when you employed one big accounting firm like that, at the time, they did the auditing work, and they also did a whole bunch of consulting work. All right, so consulting work was becoming this really big field to the point that you could have $50 million in consulting work, and your auditing work, which was how accounting firms became so big, was $1 million. All right, so I was lucky enough to, it's been a long time now, probably 5+ years ago, I went out to Vegas to the ACFE conference, which is Certified Fraud Examiners Conference, and the CFO from Enron spoke. All right, and so there was probably 2,000 or 3,000 people there. It was gigantic, and it was only probably 100 educators. The rest were just people that were certified fraud examiners or wannabe certified fraud examiners. And he spoke about it, and one of the things we're going to talk about here is the type of person that typically commits a fraud, because it's something that as an accountant or as an auditor or as someone in a business in a leadership role, you kind of got to look for that individual. This person was not that type of individual. Like in his presentation that lasted about an hour, he broke down several times. And your typical fraudster, a lot of times has that very charismatic personality where they can kind of get anybody to work with them. And what he said about what happened was that when the act originally started, what he did was legal with the financial statements. But he had this gut feeling that what he did, he shouldn't do. So even though it was okay to do it on the financial statements, it was at some type of journal entry, and he was classifying assets or expenses, and I can't remember, I have to pull my notes out again, I'm starting to lose my memory of it, a certain way. But he could do it, and he kept saying that over and over again. What he did originally, he could do. But it had to be adjusted the next period, all right? But in his gut, he thought to himself, should I really do this? And he said one thing that he would tell everybody is if you ever think to yourself, should I do this? The answer is no. Because if you're ever thinking that in the financial field, you shouldn't have to say, should I do this? And he did it. Well, what happened the next period is they didn't adjust it. They did the same thing again. And so as soon as you didn't make that adjustment going forward, then it became something that was not correct. And so this kept happening. And when they had their audit, the auditors for Arthur Andersen caught it. And auditing starts with staff, and then senior staff, and then senior manager, and a partner. And so it was brought to the upper people at Enron by the partners and senior managers that this is a problem. And the Enron individual said, we know, we're going to adjust it in the next quarter. And the people at Arthur Andersen said, well, you can't do that. And they said, well, that's what we're going to do. We can't make the adjustment now. If we do, it's going to have this ripple effect, but we'll do it next quarter. And you can't do that. And so what Arthur Andersen should have done, the partner should have done at that point, is said, fine, but we're writing it up. And they didn't. because what the powers that be at Enron said was, if you document this, we're going to pull all the consulting work from Arthur Andersen. Do you want to be known as the partner who lost Enron as a client? And what do you think the partner that, I'm making up these numbers, that has $1 million auditing contract is thinking if he's the partner that lost the $50 million consulting contract? So they didn't document it. And then what do you think happened the next quarter? Did they make the adjustment? No. And it went on like this. And Enron stock went good. And so what did the top executives at Enron get when the stock is doing great and it looks like they're making a lot of money? Bonuses. Because usually top execs get bonuses or commissions and things like that based on how well the stock is doing. So they're getting their bonuses. And what about the partner at Andersen? He kept his contract. He looks good at the firm. He's now tied into it because the longer it goes, then he doesn't look good. So what ended up happening is it went on for a while. And at some point, some individuals inside Arthur Andersen realized something, inside Enron knew something was wrong. And it ended up being a woman that we call now blew the whistle. She went to the SEC and said something's not right. Someone that worked inside Enron said something's not right. And the SEC, and this is always just as described, okay, went into Enron one day and they describe it as a room like this with a whole bunch of staff accountants for Arthur Andersen. So you figure they're somewhere between 22 and 26, because that's typically the age of staff. We're sitting in a room like this shredding documents because Arthur Andersen was trying to cover their trail. And so they halted it. And what happened, and I was working for Reuben Brown at the time, what seemed like it was like 2 weeks was probably a 6 to 8 week period. But what do you think happened when the SEC released to the news that Enron was involved in a scandal that was overinflating their financials for years? What do you think happened to their stock price?
Drop.
It drops, just bottomed out. And within that 6 to 8 week time frame, Arthur Andersen completely collapsed. So did Enron. They both were gone because Arthur Andersen was caught up in this scandal. And the sad part about Arthur Andersen is it probably only involved one partner, a handful of managers that actually knew what was going on. All the staff people doing the work, they didn't know what was going on. They didn't do the entries. They didn't say it was okay. But everyone that worked for Arthur Andersen went under because of that handful of individuals. And they probably had 10,000 employees all over the country, the world, working for them. So Arthur Andersen collapsed, Enron collapsed, their stock went to zero. The woman that blew the whistle had to be put in a witness protection program because of death threats. Because what happened when all of that Enron stock went to zero? What if you owned stock in Enron?
Didn't get it.
You didn't get it. There were people that were days away from retiring that lost all their stock. And Enron had a policy that if you invested in the 401k, they matched your 401k, which is a great policy. They matched it in their stock. Okay, that's common. But they required you to put all your money in their stock. So there are people that worked there it's an energy company, 40, 50 years. And all their retirement was now 100% gone because everything they had in their 401k was in Enron stock.
But they compensated?
No, they didn't have any money. Enron went bankrupt. Enron was gone. It's no longer in existence, completely gone. So these individuals that had been working there these 40, 50 years, even 30 years, 20 years, anyone, if you've been working there a week, you were gone. But the advantage for you is you'd been working there a week. It was really, so this woman was getting death threats. So the top people, the CFO went to jail, and he's obviously out. The one individual killed himself before he went to jail. Another individual killed himself in jail. Of the top. The CEO, Ken Lay, the one person who probably drove a lot of it, didn't go to jail at all. Because the person who drives a lot of the frauds, they're very careful not to put their name on anything. It's not by email that I'm going to email you and say, yes, go ahead and do the adjustment. It's verbal communication. You can't prove verbal communication. So the other executives all got in trouble, but they could never put anything on Ken Lee. So what changed after that was something called Sarbanes-Oxley. All right, that's a senator and a state representative got together and said, we can't have this happen again. All right, and so when they did, they came up with new rules. Number one, a company cannot make you put your money in their stock. So now if you work, like when I worked at AT&T and when I worked at Mallinckrodt, my money, I got to put in whatever I wanted. And then if AT&T matched it, that went in AT&T stock. So individuals that worked there 30 or 40 years, their money was in whatever they wanted, and then they lost maybe the Enron portion of it. So they wouldn't lose their entire life savings. All right? So that was one thing. Another thing is you can't do the audit and the consulting. You got to pick one. That way you can't sit there and kind of blackmail individuals into doing one. And the funny thing, if you want to find, I find, or ironic might be a better word for it, is here he's saying if you put this adjustment in, you're going to lose the consulting. By not putting the adjustment in, they lost both. So he would have been better off just saying we're not going to do it. They wouldn't have lost the consulting. The company was not doing the right thing. So the partner in charge should have. Now, Arthur Andersen ended up suing to prove that they were not at fault. It was just that handful of individuals. They actually won their case, but the company's name was already destroyed. Reuben Brown, who I worked for at the time, we probably hired 20 people from Arthur Andersen because every location in every big city went under. So both companies were completely destroyed. They also, every company that's on the SEC has to have what's called a tip line. So individuals like that woman can call in and be anonymous so they don't have to get death threats and things like that to tell when something's wrong.
What a courageous woman.
Oh, yeah.
How?
And the thing is, people gave her death threats because they lost everything, but eventually that company would have been found out at some point. Would have been the day the woman turned them in? No, but it would have. The SEC would have figured it out. It was not this woman's fault. They just put the blame on her because obviously they're wanting to retire at the age of 65 or 70, wherever they were, and they now don't have any money. It was not her fault. It was the company's fault. So there's something called a fraud triangle. Right? The fraud triangle looks like exactly what you have on here. And you'll see different terms for it depending on what book you use. But you have something called the rationalization. And that's what we were just talking about with the people at Enron. The first thing was not illegal. So the guy was like, okay, I'll do this. Who told him to do it originally and why? He didn't really go into the details. But the rationalization was, next month I'm going to do an adjustment. I was told to do it. It was obviously going to inflate the stock price. There's a reason. All right, I'm going to do it. And then there's always something called the incentive. What do you think the incentive is most of the time? Money. Yep, the incentive is usually money. In Enron's case, it was money. The better the stock did, you get usually some type of bonus. So that's usually the incentive. And then the key thing is you have to have the opportunity. And if you think about it, if you take away the opportunity, then they can't do it. That's where it all starts. And that's where you come into play from the accounting side. If you don't give someone the opportunity to do it, then you don't have to worry about the incentive and you don't have to worry about the rationalization. If they can't do the theft or they can't do the fraud, then you don't have to worry about everything else. And we're going to continue. We're going to talk about cash. Cash is very difficult to protect because who owns cash? The person who's holding it. If I dropped a $20 bill right there and said, grab it, who owns it?
Whoever grabbed it.
Whoever, no.
Oh, if it's
If I drop it right
oh.
there and say, get it, who owns it? Whoever gets it first. Right? If Lucas grabs it and you punch him and grab it from him, you get it. Right? In my house, it seems to be everybody's money. If the little guy finds, the 12-year-old finds money, he says it. So when it's in the wash, guess who owns it? Me. Right? You don't clean out your pockets, it's my money. So unfortunately, it's usually change because nobody has any money, but that's kind of the rule I go with. So cash is really hard, and that's why cash has its own little thing at the end of this chapter that we'll spend on. So what Sarbanes-Oxley came up with, which is typically called SOX in the accounting world, is first of all on the incentive. What they tried to do is, okay, let's make the fines even higher. So if you get caught, you have to pay such a big fine that in order to be an incentive to steal, it has to be a lot of money that you're going to go after because the fines are so high. All right, and then the prison terms are even higher. So if you get caught and you're a big executive, the prison term's high. Encourage honesty. The tip line, the whistleblower, the ethics code. All right, the tip line and the whistleblower protection, those are huge because you're encouraging someone who sees it to give them a way out to report it without who it is. And every company on the SEC has to have a tip line and a whistleblower line. They have to have that. Every public accounting firm that I'm aware of has the same thing, where you can call and make an anonymous tip. Ethics code is something most companies have you sign. My only problem with the ethics code, this is the skeptic in me, is you can sign it, and it doesn't really mean anything. I'm pretty sure that anyone at Enron would have signed it. All right, I'm pretty sure any politician would sign an ethics code. Doesn't mean a lot in my mind. It's a piece of paper. The other two things are pretty good. And then reducing the opportunities. Reducing the opportunities is what we're going to spend some time on here, and that's called internal controls. There's two different types of internal controls. You have detective and preventive. A detective controls finds the problem after it happens. A preventive control keeps it from happening in the first place. So for example, all of you have a password in order to get into Blackboard and to get into Banner. That's a preventive control. The only way that someone can get in Blackboard and see your grades or log into Banner and see your information is if you give them your password. And I don't even know if you guys truly understand this, but all of you are 18. I don't believe I have any dual credit students in here. So the only way your parents can see your grades is if you give them your password. As a teacher, sometimes that's, or as a parent, that to me is frustrating because if I'm helping pay for your tuition, I think I need to see your grades. But I just made that rule with my son, and guess who has the password? I do. So, but I also have to pay the tuition, which is on the same account, so I kind of like that. So that's up to you, though. You have control over that. Another internal control is that door. Keeping that door locked, which we didn't used to have to do until these computers started having some unpleasant images being brought up on them when we weren't in here. People were using the internet for things they shouldn't use. So now that door is kept locked when classes aren't in here. All right? That's a preventive control. Don't let it happen in the first place. All right? Detective is when you go in and you run a report to find out how many people have accessed a system with unauthorized access. Okay, now you found out they did it, you got to go change their user ID. That's detecting after the fact. All right, so there's internal controls consists of actions on all different levels. And the next few slides we're going to talk about really go a little bit into the auditing side, so we'll kind of go quickly through them. I'm not going to test you on the overall names, but so you have different areas of the organization. You have operations, reporting, and compliance. And then within those, I lived with this little rubric you're going to see for a while. You have what's called the control environment, the risk assessment, which you always do before you go in and you do an audit or you look at the internal controls. You have the control activities, information and communication, and then you have what's called the monitoring activities. And it turns into this cube. All right? And so this cube is how you look at everything. You have your objectives, your operations day to day, your reporting, and then whether or not you're complying with rules and regulations. And then they intersect with all the levels this way, and then the functions of your organization this way. Okay? So these are the control components. So you have to look at each one of those and the organizations at their level. So we're going to take a look. There are 5 internal controls. I have one that I think is the most important. So when we're done with the 5, you guys can try to figure out if you know or you think you know what my most important internal control is. Okay? It should be obvious, but we'll see. All right, the first one is called establishing responsibilities. That's a P. Establish responsibilities. All right. Establish responsibilities means that you are telling everybody what their job is. Like you have a certain role. So that is your responsibility. If you are the mailroom clerk, you open the mail, you distribute the mail. If you're accounts payable, you're responsible for writing the checks, all right, and posting it to the accounts. So here they give you assign each task to only one employee. Now, if you're in a big enough company, you could have 4 employees doing that, but each task is assigned to one employee. So for example, they tell you each cashier has a drawer at the beginning of a shift. So whether you're looking at Walmart, and not every company does this, I already know, but if you're at Schnucks or Walmart or whatever and you're the cashier, you go to your drawer, you get it, and then you sign in at the register and you do your shift. What is that doing?
If the drawer's short.
If they know it's you, right? If you share a drawer, at the end of the shift, what do you have to do? If it's short,
At the end of your shift?
well, if you share a drawer and at the end of the shift and you're short, do you know who's short? No. And if it's a big deal, some companies don't care. Some companies are like, okay, every day we're going to be short or over, and they have a threshold, $100. So they're good. But what happens if you're really short? Then you don't know who made the mistake, right? So a lot of companies have a threshold of what's considered good to be under and over. And then what they'll do is if they share drawers, if that drawer is consistently over, wrong way, under by so much, they're going to start tracking who's on those drawers that are consistently under. If you're over, they're going to be happy, but some customers are not going to be. So someone doesn't know how to add very well, all right? Because if you think about McDonald's, do they have one person at that drawer all the time? Or is it sometimes somebody running up, whoever's doing it? Okay. So they'll look at it by shift, and they'll try to figure out if people can't add. And I think we've all been to McDonald's where they might need a little bit of help adding to give your change. Okay. So then segregation of duties says, do not make one person responsible for the entire process. Inventory buyers do not approve payments to suppliers. What do you think we mean of that? Why do we not do that? Segregation of duties. Inventory buyers do not get to approve payments to suppliers. Why do we separate that?
Take the inventories and then just mark that it's just all came.
We could. If they approve payment, they could say everything was here, and then they pay the supplier. The supplier could be somebody that they know who it is. So therefore, you're paying for a full order that you didn't get. All right, so another example is, my first job, well, I actually had it during school, but it was also my first real job. So my first job was also my first real job, which a lot of times, if you're able to get an internship, can happen. So it was a very small company, and I was the accounts payable person. I was the computer person. I also got the mail. All right, that came into the big company. So if you have someone that gets the mail comes in, and it's given to the various departments, accounts receivable, accounts payable, all right? And that could be 2 different people. And then the mail's opened. I just open. It's posted. It's taken to the bank. And it's reconciled. Should everything but this be done by the same person? No. Right. And then add to that reports. I did everything but that. I mean, it was a complete internal control bust. I got the mail from the father company. I opened it. I took out the checks and cash. Don't mail cash, but got the cash. I posted it to their accounts. I ran the report. I took the money to the bank. I got the bank receipt. I reconciled it. And I filed the monthly reports because I ran the computers. That was not a good internal control. Now, as a small company, and with small companies, sometimes it's hard to have multiple people do multiple jobs. You run into that problem. But we had at least 20 people, even though it was small. So at a minimum, the accounts receivable person should have overlapped into here somewhere and double checked. Either taken the stuff to the bank, had the father company have somebody take everything to the bank, and then they could have taken what I posted, what went to the bank, and then the accounts receivable person could have matched them. That was a big break in. The company still exists, so obviously I did a good job. But I didn't take anything. But that was a big break in control. All right, restricting access. This is logical and physical access. And I explained what both those are. Passwords, like you guys have already, and it's actually the locks on the door. So logical and physical access. Hopefully that one doesn't need any explanation. And then we have document procedures. Right. And document procedures, they say that you need to be able to show activities have occurred. What happened? One way to do this is by using pre-numbered checks or digitally numbered documents, such as POs and receiving documents. That way you know when you have a pre-numbered check that check number 124 went and paid the supplier. So if there's any doubt that you paid them, besides a canceled check, you know that it went out that way. Or that PO number 1550 was the purchase order for this company. So you have ways of finding these documents. And then the last one is your independent verification. And that is having somebody else check your work. Right, somebody outside, which I didn't have anything in here. Now, somebody did do a bank statement once in a while. End of the month, the accounts receivable person did a bank statement. But the damage could have been done before they did the bank statement. All they did is make sure that the ending report I ran matched what was in the bank. And now people don't send cash, so that took away that option. But when people were mailing cash in all the time, that was a horrible way to not have another control in there. Go compare the company's balance with others. There are some control limitations when you look at this. All right, you got to make sure, you got to be able to tell the difference between fraud and human error. All right, fraud and human error. There's a big difference. Going in there and me making a mistake adding is a big difference between that and me stealing. If there's a difference of $100 and I just can't add, then you got to make sure. And that's what I said about McDonald's, right? Is the girl at the register stealing, or can she just not make change? Right. And there's honest people in the world that will be like, you just gave me change for a 10 and I gave you a 5. And there's people in the world that would be like, got it, right? And they walk away and they take the change that you gave them. So, do you have someone that's just not qualified? They maybe need to be back on fries instead of the cash register. Or are they purposely taking the money? So you got to make sure you kind of keep track of that. And then the other thing, which Sarbanes-Oxley did bring about, is what's the cost benefit? Are you spending so much money to put in these internal controls that you are actually not benefiting from the savings? And that's where the size of the company is going to make a difference. They couldn't go out and hire somebody else to come in and put a control in for me. It was a small company. I mean, I was the entire accounts payable and computer person at the age of 23. Okay, that's not a very big company for me to have those two jobs at the age of 23, which is one of the reasons I didn't stay there, right? So you got to figure out, well, they can't hire somebody else. So you got to kind of figure out where's your benefit, how well do you know your employees. Small companies usually know their employees. And I'll give more examples of that when we get to cash here in a second. So, all right, let's work on some problems. As soon as I do it.